feel like a lot. The 2-1 buy down is an interest rate option that people can access. And today we're going to talk about how to access that and the best way to set that up. And then we are recording the meeting, so we'll be able to send that out after we're done. So if there's somebody who wasn't able to be on, they'll be able to access the information. So the 2-1 buy down is just an interest rate option that is seller funded. So that's the big thing. That's the big difference, right? Like usually buyers pay the discount points, even if they're being paid by seller concessions. This is just a little bit different. So we'll go over that. I'm going to share our screen and we'll do a PowerPoint, not super long. And Carla, if you can allow me to share my screen, I have it, it's disabled right now. Let's see. All right, thanks. Okay,
Start slideshow.
1 second.
Okay.
All right, I gave you a look, Ken, but where do you start the
It's right
slideshow?
there. Slideshow.
Oh, I just didn't see it. Sorry.
From beginning.
Oops. 1 second. I am like really never the very technical. There we go. So I'll flip your slide. So, and for those of you who don't know us, I'm Danielle Prost. I'm the branch manager of Prost Mortgage Group. We're located in Cold Spring. And then with me is Ken Prost, who is our one of our loan officers. Joining us is also Victor, a loan officer with us, and Brian. So they're also on the call. So I'll just do a little bit of a brief explanation because I feel like we're all starting to hear a lot about this. So I really want to make sure we're all educated and able to offer this product to our buyers and sellers. So a 2-1 buy down is a type of financing that lowers the borrower's interest rate on a mortgage for the first 2 years before it rises to the current locked rate. The start rate is 2% lower than the locked rate for the first 12 months. So for the first 12 months, if the lock rate today is 7%, then for the first 12 months, it'll be 5%. The next 12 months will be 6%. And then Ken will take over. I can do your slides for you.
Okay. Yeah. And move the camera. Pictures there. All right. Okay. Oh, sorry. So having chair issues. The 2-1 buy down strategy is good for all sellers, including builders, and especially in this market, it makes the property more attractive to the buyers, and it's a win-win basically for both buyer and seller. To make up the interest rate that the lender will receive in the early years, the seller basically prepays the interest the difference up front at closing, and we'll go into more details about that in a second. The buy down is temporary. It's for the first 2 years, as Danielle mentioned, 2% the first year, 1% reduction the second year, and they pay the fee in the form of basically seller concessions, but it's discount points as a lump sum that are deposited into an escrow account held by the lender, held by us, and they're used to subsidize the payment for the first 2 years for the buyer. And the charges do show as a fee on the seller side at closing.
So can the seller write that off on their taxes since it's on their side?
I would imagine yes, but that would be a question for an accountant.
So I'm going to find out that though from our accountant. Like if somebody itemizes their deductions, like a lot of us do, are they able to itemize that? So I'll find that out and I'll shoot out the answer because I think that's another, it's just another benefit to the seller. And then the buyer, any discount points that appears on the buyer side, they would get a 1098 or whatever.
Yeah, it's tax deductible.
And that's tax deductible.
Yeah, so that's a good question, actually. Find that answer. All right. So it's as we mentioned, it's an incentive for the buyer, and it makes it much more attractive to have this as an option when you're listing a property, marketing it, as a seller, that you'll offer the 2-1 buy down. It's a powerful tool. And then you'll see in a minute how it can be much more attractive versus a price reduction on the seller side. So here's the screen of what we see in our mortgage software. And if you're driving, I know you can't see some of these numbers, but it shows the cost to buy. So basically assuming a $400,000 purchase price, and the buyer puts 5% down, and it's based on a 7% start rate or note rate, 30-year fixed at 7%. The loan amount's $380,000. And then the first year, instead of 7% rate, the buyer pays a payment based on 5% rate. And the monthly savings on the payment to the buyer is $488 a month. So it's almost $500 a month savings on the payment for the first year, which is super powerful in this market. So you take that times 12, that equates to $5,858 is the cost for the buy down the first year. And then the second year, it's 6% rate. The savings is roughly $250 a month. And then the total cost for that year for the buy down is $29.98, so $3,000. The grand total for the seller buy down is $88.57, or 2.215% of the purchase price. And now if the rate is slightly higher, the cost, the percentage is a little bit higher. It ranges from the 2.21 to 2.3, 2.33, depending on what the rate is. But it's basically offering 2.215% seller concessions, or additional if they wanted to offer more to cover other closing costs. But you have to have at least that much in seller concessions for this scenario. So we'll look at a couple comparisons here. So the seller's asking $400,000 for the property. A traditional price reduction is, let's say the buyer offered $88.57 less, so $9,000 less for easy math. That takes it down to $391,000 price that the buyer is going to potentially pay instead of $400,000. So that's one option. And then so the buyer offered $391,143. The new price with the $391,143 with 5% down at a 7% interest rate brings in the principal and interest payment at $2,472 a month. So that's just doing a price reduction, hypothetical price reduction in this case is what this is. So that's what that is. So remember, $2,472. The traditional thinking is that in the past, if there's a price reduction, they just lower that amount, and the buyer saves $60 a month on their payment. So by having the lower purchase price of $391 and change, the buyer's monthly mortgage payment reduces by $60 a month. Not terrible, but it's not the same as the 2-1 buy down. So with the buy down strategy, you don't lower the sales price, and we'll talk about this more in a minute, instead of, if you did lower the sales price as a seller's agent and seller, we can talk about renegotiating it back up to the original list price. But let's say we keep the sales price at $400,000 and negotiate a buy down instead of the price reduction. So the seller is going to accept the $400,000 offer, and the buyer is going to pay based on $400,000, and the seller would net the same as if they did a price reduction, because they're going to pay the concessions to cover the buy down costs. But next screen, now we make it even more attractive for the buyer and really for the seller. The home's more marketable in a higher interest rate environment, and an environment where it may have slowed down a little bit as far as buyers that are interested in making offers. So it's a win-win again for the buyer and the seller. So remember, we talked about the $391,143 price, potential lower price with 5% down. Again, that's $2,472 a month payment. But let's compare that to the buy down. So, oops, sorry about that. So if we do
enter the group number that
sorry about that. So if we have the 5% interest rate for the buy down, the payment goes down to $2,039 a month. Okay. And well, let me back up. I'm sorry. I skipped the first part. So if you don't do the buy down and you just have, I'm sorry, I'm getting confused by the phone call. The fully amortized payment, let me back up. The fully amortized payment at 7% is $2,528. So that's $59 higher than if you did the price reduction. Okay. But because the first year the rate's going to be 5%, the new principal and interest is $2,039, and there's the savings of $488 a month, or 19% reduction in the payment for year one. Year two will be at 6%. That payment is $2,278, so it's a $250 savings per month for the second year. And then year three, that's where we get the fully amortized payment back to the note rate, $2,528. So the note rate is still 7%, but the seller is basically subsidizing that difference for the first 2 years. And then what's really critical to this, because you can do a permanent buy down. The seller can do concessions and buy down the rate for the buyer, or help the buyer buy down the rate with the concessions. But then you're stuck with whatever that rate is for the remainder of the loan. And if you refinance after a year, you don't get a refund of that buy down. But
On a permanent buy down.
On a permanent buy down, right? But with the temporary buy down, if the home is refinanced or sold within the first 24 months, the remaining escrow funds are credited back to the buyer, to the borrower. So, and we'll show you an example in a minute, but remember the screen I showed you the cost of the buy down year one and year two. There's money that's going to be there in the escrow, and if this strategy works like we're believing it will, there's a good chance that a lot of these folks are going to want to refinance within the first 2 years with lower interest rates available, and they won't lose out on that money that they had structured in the original loan. Okay, so let's do a comparison. So we're going to compare the reduced price of $391,143 at $2,472 a month, a savings of $59 a month from the $400,000 original price, or the buy down makes the payment $2,039 year one, savings of $488, and then year two, $2,278 a month payment and $250 reduction in the payment. And then year three, we go back to the original note rate if you don't refinance or do anything with it. And again, you're going to save almost $500 a month. So what does that equate to? If you're a buyer in this environment and you want to lower that payment, $488 a month, you'd have to buy a house that's lower in price by $73,000, basically. Or the seller would have to reduce the price by $73,350, $73,000. So it really makes a difference in the buyer's purchasing power as far as their payment they want to be at, and also for the seller not having to lower the price dramatically to attract buyers for a certain payment. And then this is the calculation. There's another screen coming up as well that we can show, but I'll kind of highlight it right now. So year one savings, $488 a month. That's $5,858. So let's say after year one, the rates go down to the market rates, go down to 5.25, which, by the way, I will mention that we were at a conference, and one of the owners of our company who's on the MBA, the Mortgage Bankers Association board, he showed a slide, a projection of where the rates will be at the end of 2023 and the end of 2024. And the consensus is, the belief is that they're probably going to be back in the low fives, potentially by the end of next year, which would be great. And then by 2024, potentially in the high fours. So let's say after year one, the rates go down dramatically and this buyer wants to refinance. So if you look at year two savings, it says $249 a month savings on the payment times 12. So that's the $3,000. So let's say there's $3,000 left over in the escrow account. That's where that money is coming from that's going to be refunded. to the principal. It's a principal reduction. So hopefully that makes sense. So again, the buyer doesn't lose it. If they refinance, they're going to have a lower payoff basically, because there's money that's left over in escrow that's going to be refunded to them. And then this is the chart that we have in our mortgage software, and it shows the two different years and the buy downs.
And there's no cost to the seller or to the buyer to administer this program. So the lender is going to keep this money in a separate account and every month supplement their monthly payment for as long as they have, year, if they keep the loan through at least the end of the third year.
Yeah, just like you have escrow for property taxes and home insurance, the lender administers that or manages that escrow account. This escrow for the buy down is managed as well. And not that it matters, but it kind of matters, right? If you're a listing agent or you're a buyer's agent and your commission is 3%, a reduction in price of $9,000 is roughly $265 reduction in your commission. So here's some questions as a listing agent that you want to hopefully avoid, and this is why the 2-1 buy down is so important in this market. Is you don't want to have questions like this from your seller. Why is my home not selling? Why am I not getting multiple offers? There's been a shift in the market. Definitely, I think everybody would agree.
Especially for the higher price homes, especially for the homes that aren't really more like first time home buyer.
Yep. Rates are going up. Are the buyers scared? How much do I reduce my price to attract buyers? Why do the comps support sales price but no offers? And one thing I want to bring up now is we talked about a $9,000 price reduction, but the truth of the matter, from what I've seen, and I just did a little sampling with Fort Mitchell, Kentucky, looking at I did a search on Zillow of homes that have had at least 3% reduction in price. And there were a ton, and a lot of them larger homes, 30,000 price reduction, 40,000 price reduction. Most of them were at least 10,000. So let's say your $400,000 house that you have listed, you're looking at reducing the price to $380, not a $9,000 reduction in price. You're looking at reducing it to $380. So as a listing agent, as a seller, instead of reducing it $20,000 in price, offer the 2-1 buy down to a potential buyer, market it that you have that, you're willing to do that, and you still get the $400,000 price. The buyer pays $400,000, and the seller does a $9,000 buy down, so concessions of that amount. Let's say the seller's going to net $11,000 more than they would if they reduced the price to $380. So that's just with a $20,000 price reduction. But some of the homes I saw in Fort Mitchell, the small sample that I did, there were $50,000 reduction. So it's a nice alternative for the seller and also for the buyer to get that lower payment. So what do we need with this? It's pretty standard. It's nothing super different or fancy. On the purchase agreement or addendum, the offer should read just like normal: seller to contribute X% or X dollars towards buyer or buyer closing costs, prepaids, and or temporary buy down.
And so because of the cost of the buy down, it's significant, right? I mean, in this example, it was like $9,000. That can cause the loan to go into a high cost situation if it's not put on. That's why it has to be put on the seller's side. It's required for the product. So it's important that this be correct. So, and if you didn't have it correct the first time we got it, we would just get an addendum clarifying how those monies are supposed to be used so that the borrower isn't falling into a high cost scenario and that it's recorded correctly on the seller's side. So before we get to questions, I do want to interject just a few things. One is we will be having yard signs available for the 2-1 buy down so that you could put in front of listings to offer that. Because I think that's a big thing, right? Like how to let people know that this seller is willing to do that. That's what makes it the marketability. So we'll have yard signs. I'm waiting for compliance to approve it. So basically something like this home qualifies for a 2% interest rate reduction is what I'm wanting to. We also can prepare flyers for you so that we can, that I can have specific on there with the program information, product information, and then also the payment information. And I can get those done in about 10 minutes. So, you know, anytime, always just shoot us a message, Ken or myself. And I can run we can always run scenarios. We have a calculator just for this. So if you're looking at price reductions, you can look instead at the different costs for the buy downs.
Right.
And the difference between the permanent buy down and temporary, because obviously you can always do a permanent buy down, it's really the cost and that it's not funded in the same way. So it's not going to be as much of an incentive for the seller to do that.
Right.
So does anybody have any questions? And either take
Yes.
yourself. Yeah, go ahead.
So I'm a agent and an investor. I have 5 properties right now while all this is going on. I just listed one for $600,000. No activity for 10 days. And if it had been June, would have been
Right.
sight unseen, right? I mean, there's 2 new builds on the street that are 670 and 650. Mine's a total rehab. The only thing that's not new is the bricks. So that's what caught my attention when I saw you guys advertise this earlier this week. I thought maybe I could advertise that as this, exactly what you just said. And I didn't know if it was okay to say that, like, this property, this home qualifies for a 2%.
Yeah, and
Reduction.
so like on that one, hold on, let me.
I
So
thought it was
600, let's say we just kept it at 600,000. So, and I'm going to do a slightly higher. So it'd be 13,500 to do a buy down on that.
And we'll double check the numbers just to make sure.
Yeah, this is really rough math because there's a calculator for it
That's
and
the
everything.
1 year though.
Right.
Year you just did.
No, I did two.
Oh, you,
I did 2.25.
just 2% for, okay. We'll
double,
we'll
but let's-
confirm it. Yeah.
Let's say it's 15,000. It's, it's whatever. It's still like when you have a price that's high, you're not looking at doing a $10,000 price reduction.
No.
Typically, right? Like it's more like, oh, it was lower 25,000 or whatever. And so, and then for a buyer to be able to get into the home for, $700 less the first year, and then $500 less the second year, using rough numbers, that's big to a buyer. The one thing that's important is that the buyer does have to qualify on the note rate.
Yeah, that's true.
So in today's market, let's say they were locked in at 7%, they have to qualify at 7%. But because again, we don't want what happened in 2008 where it's like,
Right. I know.
they can't, which is totally fine. They should, that's,
Right.
well, it's not used to get a buyer to qualify. It's used to get a buyer to be interested in the property that, if there's other houses that maybe have been price reduced to 550, it's like, oh no, but this house, my payment's going to go down. And most people do think their rates are going to be going down, if not next year, at least the year after. So they're locking in for a very temporary. So I'm happy to send you any flyers for that specific property. We'll have yard signs probably in the next week. They'll be in and we'll send out, an email about when we have them available and we can drop them off. Because it's like, well, how do you let everybody know that the seller's willing to do this? I think that's a really easy way. Also, you can always put it on your listing as well in the MLS.
And that's what I was, I thought allowed to actually write this property qualifies for a 2%. I'm in Ohio too.
Sure, that's fine. Yeah, we're in Ohio, Indiana, Michigan, Texas.
Okay.
Yeah.
Yeah.
Happy to do whatever we can to help you with that. Anybody else have any questions?
Well, feel free to chime in if you do. I do want to make an announcement. And I think Danielle knows this because we talked about it, but nobody else on the call, including our staff, knows about this. So I got word, and it's official as far as it's reliable. It's from our pricing department, but it's going to be soon, maybe within a few weeks. I don't want to say for sure within 2 weeks, but in addition to the 2-1 buy down, and we also have the 1-1 buy down as well. We don't have to do the 2-1 buy down, but if somebody's going to do the 2-1 buy down, they should do, in my opinion, I think you should do that because it's more impactful than a 1-1 buy down, where it's just a 1 year buy down. but we're going to have a 3-2-1 buy down program. So it'll reduce so Julia, I think it was you who asked the question, on a huge loan like that, 700,000, 600,000, it'd be a 3% reduction in the interest rate. So it takes the rate from 7, let's say, or whatever it is, to 4% the first year. And that's even more savings to the buyer. And super excited about that. That's going to be out soon. We have it available for conventional programs and FHA right now. They're finalizing it for VA, the 2-1 buy down, the 2-1 buy down for VA and the rest of Gubbies in the next week. And then after that, so within a few weeks, it sounds like we'll have the 3-2-1 buy down.
And of course, we'll send out an announcement when we get that. And then Julia, if you don't mind, I don't know if you see it in the chat, but just if you can shoot us your email address. So I just want to make sure we have it in our system so I can let you know when the yard signs are in. That would be great.
Yeah, I will. I get emails from you also. I'm sure you do, but I will. But I'll
we like to communicate a lot. So that's really all that we had. Wanted to make sure we shared this. I mean, I think knowledge is so powerful in this market, and how can we better, serve our buyers and sellers? Because it's not just about the buyers too. It's also about the sellers not having to lower their price.
Like I own it.
Sure.
I'm the agent. Yeah. So while I want to help the buyer, I obviously still want to.
I feel like this is one of the few that's really a win-win to both. It's usually in our industry, everything's really buyer sided, right? Like on our end, right? When we're the lender. But this is one where it's truly impactful for both the buyer and the seller.
I have a question.
Yeah, Becky.
So do the requirements change depending on whether it's temporary or permanent?
So if it's a permanent buy down, then the buyer qualifies on that note rate. So that's where it can be impactful. A permanent buy down is going to be really helpful if we have a tight buyer. But if they refinance or they do anything within those first couple years of the buy down, they don't ever get that money back. And it's more expensive.
Yeah.
Because you're buying it down permanently. So
Yeah.
you're not going to have a bit more.
You're not going to have a 2% interest rate reduction. You might have a 0.5% interest rate reduction because it's based on the life of the loan, not the first 2 years or first year. So, or the second year, sorry. But that's the big difference. When I learned that the temporary 2-1 buy down had the refund of the escrow feature, which makes sense, that made it even more attractive in this market.
Because most people, I mean, if you're talking, somebody's going to have to pay 4 or 5 points to really significantly buy down their rate.
They're not going to be able to.
Well, and if you put it, it's going to throw it. So with how the margins are and with how the rates are, it's really the temporary buy down that is what we really should be trying to promote to buyers and sellers, unless it's a qualification issue and then we have to look at the permanent buy down, or they need to look at a different house.
So this is I do lots of things in cash, so I haven't really used a lender as much, but if I'm understanding, I just didn't know that there was a temporary buy down. But in years past, I mean, you could always, as the buyer, buy down your rate by paying the points to buy down. So this is just the seller offering to do it in reverse. And in this case, there's a temporary cap to it.
And the kind of the difference in the past is how gets real technical, but how our loans are being sold on the back end. This is industry wide. Because there's so much, there's so many people are thinking, so many professionals are thinking that the rates are going to go down in the next year or two significantly. There's not any real money for the loans to be sold, because what investor wants to buy a loan at 7% when the forecast is that the rates are going to go down substantially within the next 12 to 18 months? That investor is never going to make the money back that they're paying for the purchase of that loan. And everybody sells their loans. They're either selling on the warehouse line and they're still servicing, like everybody's selling their loans.
Yeah, so that makes sense to me because I buy notes as well, but I'm not buying them at 7%.
Right. And so people are like, well, why would the investors, the big investors, Chase, Wells Fargo, whomever, why would I pay you the same amount that I would have a year ago? So the buyers are already, for most loans, having to pay a point or two or more to even get a par rate. So there's not any like free rates, like discount points are 99% of the time we're seeing them 740 credit score. It doesn't matter because there's not enough revenue for the lenders on the back end like there normally would be. And I'm not talking about us, I'm talking about like the corporations. Like,
Yeah.
because loan officers get paid like realtor, like it's a base commission price. So it gets really complex about why the cost for the rates are so high right now. And so having the buy down, it's like they're already paying some points anyway. Pay more points, put some on the seller side, get a rate reduction so that you can just stay in the market for that year or two. So that's a little bit of that.
And yeah, and the last thing, and since the market is a little bit more balanced now than it was early in the year, it's something that buyers are able to get the seller sometimes or often to agree to, because instead of getting 20 offers in 10 hours, they're getting maybe 2 offers in 2 weeks, is what I'm hearing a lot of. It's slowed down quite a bit for the seller as far as the activity. So it's more attractive for them to do it and the buyer to take it on as well.
All right, well, we won't keep you guys, don't want to go past our time too much. So feel free to send us any questions, call us whenever. We're always happy to try to help everybody be successful in their sales or buying journey. So
Everybody have a good day.
have a great day.
Thank you. You too.
Bye-bye.